Crypto is pumping. The equity markets are recovering from early morning losses, and we are getting ready to head into a busy week. We got corporate earnings, we got inflation data, we got Fed president speaking, all of that good stuff. It's going to be a wild one. Very excited to get into it today. Kevin, how are you doing on this wonderful day? As we get going, please hit that like button, subscribe to our channel. Nothing we say is financial advice. We are not financial advisors. We're a couple of guys who love following the markets, looking at the trends, seeing where we can find our edges, and that's what we're going to try to do for you today. So please incorporate this in your research if you want, but do more of the research on your own for any buying and selling.
Absolutely. Yeah, JWeb, doing great. Obviously, market's pumping a little bit. We have been talking about that last week, potential push to 30 to 33K for Bitcoin. So starting to make that progression up. We broke through the supply zone. So I'm very happy to see that what the play that we've been anticipating is playing out as is right now. But yeah, it's really interesting to see. We got tons of stuff this week, and then we got some interesting stuff to talk about later that unfortunately isn't the greatest news, but it's something that we need to keep an eye on. So I'm really excited to get into this one.
Happy Monday, Ace. We got a big week ahead. Let's jump into what we are looking at. So we have 6 Fed presidents speaking throughout the week. We're going to hear their tone on the state of the economy. Some will be speaking before inflation data. Some will be speaking after inflation data. We have, on that note, CPI Wednesday. FOMC minutes from the March meeting are also coming out on Wednesday. We have PPI on Thursday, and then U.S. retail sales on Friday. So the back half of the week is jammed with a lot of important data that is going to inform the Fed's decision at the next meeting. I think this week will probably be when we'll still have PCE for March coming out later this month, but I feel like this week is going to be the final deciding factor in whether or not we get a no hike, 25 basis point. I'm not hearing anyone talk about 50, but if we don't get good inflation data, 50 could be back on the table. I'm expecting inflation data to be kind of in line with expectations. I still think, the oil prices haven't been baked in yet. We'll start to see that happen soon. And then we also have a lot of big earnings from financial institutions on Thursday and Friday. We got JP Morgan, Wells Fargo, Citigroup, and Bank of New York Mellon all reporting on Thursday and Friday. I think they're reporting after hours on Friday. At least JP Morgan, Wells Fargo, and Citigroup are. I believe Bank of New York Mellon is on Thursday. But if all of those report on Friday after the close, we'll see activity in crypto, but that'll be another kind of delayed effect until the market reopens the following Monday. So it's going to be an interesting week. Like we talked about at the top, crypto saw a massive green candle day on Bitcoin. Ethereum took a huge leg up. Huge is relative. It tapped 1,900, came back down. Bitcoin is over 29,000. It's holding pretty strong there. So it's the markets are hot right now. We've talked about that we could see this playing out and being a good month for crypto and equities again before the music kind of halts in May and June.
Yeah, I completely agree. Obviously, when I didn't know that JP Morgan's coming out soon with those earnings. Obviously, that's going to interest me because I saw them on Bloomberg talking a bunch. What was it, like a week and a half ago? And I looked at the charts. I'm like, they might be BSing this whole market being bullish here. But obviously, that's one I'm going to be keeping a huge eye on. The markets are pumping right now. We were talking about how this could be, a lot of people are going short maybe a little bit too early, and this could be the leading us into what this pump is. And if we get into the point where, May turns out to be the month where things start to turn around, maybe this is the top, like a local top, then not saying history is repeating itself, but we are getting, similar fractals to what we got in 2008. That's something that's going to be really interesting to see. Again, we have tons of data. I'm really excited to see how this all plays out. And then we also have whether it's going to be 0 or 25 basis points of the next Fed hike or the next meeting. And, we talk about how, inflation's came down a pretty good amount. And again, that's because they're throwing out 50s like crazy and 75s for a good amount of time. With these 25s, this is not necessarily, we're at where we are currently. We have to get down to 2%. This might take a while. Like if we're talking about like a slow bleed, like 25s, sure, absolutely. It's, the rates are going up, but this could, this isn't a 75 basis point hike where we're going to see the impacts fairly quickly because there's just so much being increased like so rapidly. But again, this could be something that's just like a slow bleed out to the end where, this inflation fight takes a while. But I definitely do think that we are nearing a point where we are getting to a local top, and maybe this is just, it's going to be a painful, I don't know, not going to say a year and a half, but maybe into the end of this year, into next year, might be a little bit of a slow bleed for across all markets. So it'd be something really interesting to see. Again, 25 basis points here, I think, is the play though.
Yeah, I'm starting to hear more and more people talking recession when I watch Bloomberg and CNBC, and you know who was talking recession before all of them? My man Kevin. That's who was talking recession. So there's a lot of people saying they're like, oh yeah, we're gonna go into a recession in the second half. There's no, I mean, it could be happening already. I know that's what your belief is, and you're very strongly convicted in that. And we talk about The Big Short. I told you I watched it. I watched it Saturday. I had I was on nap duty with the kiddo, and he fell asleep on me for 2 hours. So I watched The Big Short while he was napping, and it was fantastic. And it's just a reminder that you're not going to hit every time, but if everyone is laughing at you and saying that you're crazy, and you're very strongly convicted that you see something they don't, it's okay to bet big on it. Don't go nuts here. Don't learn all of your life lessons from a movie, but it was a good reminder that when the market gets overly confident, there's money to be made on the other side.
100%. And one of my favorite lines from that movie is when they said, it was about the bubble. It's like, there's no indication, that's why it's a bubble. It's like, there's always markers. And, that's what we've been noticing. We've been looking at. It's key things in the markets that we've seen from previous recessions. Again, you don't even necessarily need to look at the charts. You just need to look at, old clips of Bloomberg or CNBC from back then and have people who were talking about how bullish they were going into, March of 2008. And you can see the same thing is playing out right now. But it feels like right now that there's tons of, not manipulation, but there's tons of people that are feeling extremely bullish. Like I watched Bloomberg today, and there was the CEO of Snap-on talking about how, the market, the economy, this is really encouraging. I don't know what type, you guys aren't talking about a recession. There's no way we're going to go into a recession. I'm looking at the charts, double top, and guess what? It's far away from, it's a 50s, way above the 200. So I'm like, yeah, when that decides to take a dip to the south, that's going to be a really bad drop in the price. But again, I think that a lot of people are getting overconfident, and that's greed, and that necessarily isn't the strongest sign of intelligence when people are talking.
Yeah, it's I'm curious, I just need to add this to my tabs. The Bitcoin Fear and Greed Index right now.
Sure, yeah.
It's actually not where I thought it was going to be. It's at 62. Looks like it's at 62. I figured it would be higher than that, but maybe people are getting a little wiser here, because it had been higher last week, and with this pump up today, I figured we might see an increase. Maybe when the data refreshes tomorrow, we'll see an increase in that. But yeah, I don't think it's a good time to be greedy to the upside. I think it's a good time to be patient and then get slightly greedy to the downside when we've really hit that resistance and we're on the verge of getting news that's going to send things back down. So on that note, of The Big Short, of that news send us down, you texted me yesterday saying that you thought that you had found something that no one's talking about that could be a huge opportunity to short in the future. Now, once again, we are not financial advisors. Before we get into this part of it, do not take our word for it, and please do not get involved in leverage trading or any other form of trading that you're not comfortable with purely based on our advice. That being said, Kevin, I want to hear more about what you saw on the charts and how it's relating to what's going on in the macro, and where your view on all this is going, because you don't often text me about stuff that you see in the charts that you're really excited about, but this was one of those times, and so I'm very intrigued.
Yeah, it's I will say this: I won't be shorting this industry, even though I think that it's going to absolutely tank, and I think that unfortunately it's going to be a symptom of a broader economic collapse. And it's kind of simple when you think about it, just because we're at 3.5% inflation. But the industry that I think is probably going to take a pretty good hit, and there's markers and indicators from previous recessions that show that maybe we are on the same path. Maybe a few things are different, maybe because inflation, but we're still on the same path. And that industry is staffing and recruiting. So obviously, temp work and stuff like that, people are going to be looking for work, and we're at a point where the jobs market is super tight. It's at 3.5% unemployment, which is extremely low. It's one of the lowest unemployments that we've seen in years. I think it was at like 40 something, 50 something years. It's historically low right now. And it's obvious when you think about it. It's like, okay, if this is the bottom of unemployment, obviously as unemployment rises, there's going to be these companies that aren't necessarily hiring people. They're going to be laying people off, and it's going to be, hiring freezes, and there's no work to necessarily, recruit people for. So I just want to pull up a few data things that I saw, and then we'll jump into the charts. To do the charts last. And again, I just saw this because I just was reading an article and popped up like, oh yeah, unemployment at 3.5%. Obviously, people aren't going to be getting hired. And I just want to look at some historical data and some other stuff that I read from prior articles to this year. So let's go here. I have so many tabs open right now. You have no idea. Let's see. Here it is. This is from Resume Builder. This is just one of the articles that I was looking at. But if I pull up this, we could see these are, says massive layoffs continue in tech industry and questions of an impending recession remain. Many employees fear what lies ahead for them in 2023. In December, Resume Builder surveyed 1,000 business leaders to understand how employment organizations had fared in 2022 and their outlook for 2023. These are the things that they found. It says that 61% of business leaders say their organizations will likely have layoffs in 2023. That's no surprise here. We already knew that, as the unemployment is so low and inflation is high and the rates are continuing to rise, something will have to break, and it's unfortunately unemployment. So it's probably going to increase significantly. 57% of these business leaders said that their layoffs are likely to estimate 30% or more of their workforce to be laid off in 2023. That's, again, this is per company. That's insane. 57% of 70% of companies are likely to implement a hiring freeze in 2023. And that's the one that really interested me. That means that there's going to be a huge amount of unemployed, individuals who are going to be competing for work, and we're not going to be able to find them jobs in any capacity because most of these companies are going to be unable to hire. And if we look at back into 2008, I was doing some research that we didn't see any of those hirings happen till a while after, the recession ended. There was a lot of hesitancy, and we saw temp work go up. And there's a lot of things that happened in that era where it's led us to where we are today. And this is the part that scares me the most, is that we are going into a place where a lot of what happened in 2008 has widened the gap between, people who are extremely wealthy and people who aren't as wealthy. It's pretty much eliminated the middle class. One of the key things was that when people were laid off in the 2008, 2010 era, middle management positions were pretty much completely eliminated. It got to the point when they started calling people and hiring people back. Those positions that were in the middle, at the time it was between, I think, $19 to $21 an hour. Obviously, minimum wages increased significantly also due to inflation. But those people, those positions, they did not come back as nearly as much as people who are low salary. And that just means that, the gap between these classes is going to continue widening. It's going to be harder for people to find work. We saw that wages were down also when people returned to work. So there's tons of things that are extremely scary to think about. And, back in 2008, the entire Great Recession, it was 8.7 million jobs in the United States that were lost. But they were lost within that 18-month span. And it lasted 18 months. And I think I forgot what the unemployment number went to. I think it was like close to 10%, which is insane. It doubled from 5% to 10% in a matter of 18 months. And right now we're at 3.5%. But the big difference was back in 2008, we didn't have inflation this high. We didn't have rates. We did have rates pretty high, but there's a good chance that rates can continue to go high. So there's a lot of stuff just building up, and just thinking about this, like if people start losing their jobs, obviously this industry is going to take a huge toll. I mean, if I looked at back in 2008, let me see if I can find the article from 2008 where it was talking about what happened to the recruiting industry. Let's see. I think it's this one. Back in 2008, it was more than a third of these people who were, in these firms lost their jobs. So that's one thing. It's, again, more people that are losing their jobs. And I don't know if you've ever seen, the amount of employees that some of these firms have. Like, Robert Half International, I believe they have somewhere around 30,000 employees, and they're the biggest one. And a lot of these other smaller firms, obviously, if they're not being able to be paid, none of these companies are paying them to find workers for them, then obviously they're going to have an extremely hard liquidity crunch coming their way. So again, I'm not shorting this industry because it just, I don't know, it feels almost unethical thinking about people who are going to lose their jobs and trying to get people who are going to help them find jobs in a way, get back into the industry. But it seems inevitable. And, obviously I just want to, sound the horn on people who are maybe not expecting this, how bad this could potentially get. And I think this is going to be, one of the big things that no one's talking about. And a lot of the, recruiting agencies, a lot of them are younger people that are working, people that weren't around in, 2008. And they have no idea how to prepare for some type of recession. They've never seen a true recession like 2008. So this is going to be an absolute culture shock for a lot of people. It's going to be insane, how to manage with this. How are we going to be able to find people? How are we going to be able to essentially make money, hiring when no one's hiring anyone? So it's one thing I saw, and it's not even one thing, it's a bunch of stuff I saw. And again, it's a symptom of a larger macroeconomic failure that we anticipate to come, whether it's the banking crisis, whether it's, obviously if people don't have money, then they're not going to be able to hire people. If it's, these companies are just absolutely going, tits up, like we always talk about, they're not going to hire anyone. And we saw 70% are most likely not going to hire. They're going to put a, hiring freeze. Absolutely devastating to the economy. And this is one thing that I think is, this is probably my biggest fear. This might be my biggest fear in terms of what's to come, just because I know that for a good amount of time, people will be out of work. There won't be a lot of liquidity out there. And when they do return to work, it's probably going to be similar to how it was in 2010. A lot of those middle positions are gone. Pretty much your degrees are going to be worthless. You're going to be competing with other people who are maybe more or less qualified than you for lower level positions. And, that's why, again, I just want people to prepare, and we'll look into the charts in a little bit, but that's pretty much what I found from a little bit of research after looking at the charts.
Yeah, it's a scary proposition to say the least. It'll be interesting to see how it plays out this time. Back then we didn't have the gig economy. There wasn't stuff like Uber, DoorDash, TaskRabbit, where people could go and get part-time work. Now my question is, okay, more people might turn to that as an opportunity, but as the economy begins to worsen, people are going to use those services less.
Yep.
I would imagine less people are going to be ordering out through DoorDash. Less people are going to be using Uber for rides because of how expensive it is and having to cut back on money. So this is a really big problem that, you're right, I haven't heard anyone else talking about. So let's take a look at the charts for a few of these companies. I know that you said that there's, quite a few stocks here that, are companies that do temp work. So I'd like to take a look at a few of those, if you don't mind, and we can kind of see on the stocks. And if any of those have been around, since before 2008, how are the charts looking now compared to then would be also an interesting experiment.
Absolutely. And one last thing before we go into that, because this kind of is a good segue, there's this thing called the double dip recession, how that affects, staffing firms. Obviously, that's when we get a recession followed by a small recovery that leads into a bigger recession. And I don't consider the COVID crash a recession by any means, because it only lasted a few days. However, it's technically classified as a recession. So if there could be a situation where that could have been the first dip, obviously we got the recovery, which is, we got printed into a bull run through the Fed. And maybe this is the big recession that follows. And again, as more time goes in between recessions, I still consider 2008 to, being the last recession that we actually were in. Maybe this collapse is of the same proportions or even worse. So again, it's really scary. And that's why we talk about greed and a lot of people not really paying attention to what's going on. But let's look at some of the charts. It's just, it's no way to sugarcoat this. Sometimes it just feels terrible being so negative, but you got to keep an eye on this stuff. It's good to know, potential downfall for a lot of things coming forward. But let's see if we can find one of the biggest ones. This is RHI, which is Robert Half International. They have one of the biggest firms in the U.S. And just looking at this right now, you can kind of see what the problem is. We got that 15 at 200 coming extremely close, and you're just a few bad weeks away from this crossing. And the last time this crossed, we'll go back to 2008. Obviously crossed here, and it dropped significantly. Let's go to top here, just because that looks like the top. Down here, 67% drop. The thing I did notice about this, though, compared to the major indices at that time, the S&P and the Dow, a lot of these staffing firms also peaked a few months prior to these other indices peaking. So this peaked, I think, back in July of 2007, I want to say. I'm going to get this. Or let's say this. No, that's July 2007. So it peaked in like February, and it also did something similar this year. However, it peaked after. Again, I think that's because there was such a huge money supply and people were still looking for work, or companies were still looking for work. But this peaked prior to the actual, beginning of the recession, and in some ways is an indicator of what's to come. Obviously, mass unemployment from rising interest rates and just economic collapse. Could people who are in these industries potentially be shorting these at the top because they knew that this is the absolute top. There's a bubble coming, and maybe we can make some money on the downside. Just a thought again, but it's a weird thing that happened for not all but most of these stocks. So when I look at this, obviously there was a huge collapse there, and we've pushed up a good amount. Here's the COVID crash right here. It came down and it just bounced right above. And, in a matter of what, 1, 2, 3, 4, 5, 6, 7, 8, 9, like 9 weeks, we got printed into a bull run, shot all the way up. And we got super far away from the 200. 200 remained sideways for a while, but we came down and we're coming down pretty fast. And I'm not saying that this move from top to bottom, let's say from here to where it currently isn't huge. That's a 40% drop. But, it could be a lot worse easily. Let's see what top to bottom could look like. If we go down to the COVID, it could be about 74, 75%. That's if we're using the top to bottom and, COVID being the low, that's the double bounce, the double bottom. But I do see that, once this death cross happens on the 15 to 200, we're going to be going to look for support. And that might be the ultimate key support, especially if everything else in the market's doing extremely bad. Maybe, staffing and recruiting sees a little bit worse because, well, obviously, if everything that they work for to, provide people for these jobs and there's no jobs to provide them for, how could they not, be hit worse than everyone else who's losing their job in some of these industries? So this one seems like it's just going to take a little bit worse of a hit than maybe some other industries. Let's move on to the next one. Let's see. So this is RHI. Let's look at Kelly Services. So this one on the weekly already made the death cross. So we can see it happen back here. Right there. But I just wanted to look at back in 2008 because I think it was 2008 when this one, yeah, here it is. So in 2008, we see the death cross came in and that's the drop that we got. Right?
Damn.
Yeah. So we went from $33 all the way down to $6.14, which is an 82% drop. Huge. But again, where did we top out at in this bull run? Let's see. This was May of 2007. So prior to the absolute collapse. Again, a few months prior to everything in the Dow topping out. And then, the downside where we just dropped insane amount, like 55%, I believe it was. But another indicator I saw with this one, obviously the death cross was put in much earlier. This was put in back in, let's see this death cross right here. This was put in November of 2021. So at the top of the bull market. And we could see that was also the local top here where that was put in a few months prior to the top of the bull market for us on the Dow. So it looks like these things kind of precede the actual moves in these indices. And, when they do cross, obviously they can be detrimental. And I think with interest rates continuing to rise and unemployment being so absolutely low, and there's tons of room to the upside, these things can still bleed out, even if they put the death cross in weeks or months ago. Again, a lot of this is being held up, oddly enough. Like this is in the NASDAQ Kelly Services. So the NASDAQ's been pretty strong for the past 3 months, 4 months. Maybe these are the stocks that begin to bleed and, we start to lose a lot of the strength that's behind these indices if everything starts to hit the fan.
Yeah, that makes sense. There's historical precedent for it. There's indicators on the technical side. There's indicators on the macro side. So I think this is a pretty good case you've made here.
I will go into 2 more things. So this is Paychex. Paychex is also in the NASDAQ. Look at that chart just off the bat. That 200 is way below that 50-day moving average, and this is on the weekly, and looks like it has to fill some of those gaps. I'm just looking at this right here. There's an insane amount of downside potential for this one. And the odd thing is, one of the articles that I did find, it was which I just showed recently, it was what a possible recession means for your staffing firm, and how, obviously 2008 affected the staffing and recruiting industry. The company that put that out is Advanced Partners, and they are owned by Paychex. This is also the company that the stock that we're looking at. So are they anticipating something? Maybe, possibly. I think that a lot of these industry, recruiting firms, if they're smart, they're forward thinking and they understand that what's coming. Maybe they're taking some off the top so that they can be able to afford to pay some of their employees. I don't think that's going to be necessarily the case. I think a lot of people are going to be hurt regardless. If there's no reason keeping people around if there's no work for them to do. That's unfortunately the case. And I think that might be the case for a lot of these. But again, we're talking about 30,000 people for RHI. I can go down on LinkedIn and just see how many people are employed by all these. There's like some that are 10,000. There's some that are small as 12 people on a team. Like, obviously the smaller ones are going to get hurt the most. But if you're looking at some of these other big ones, no one's safe. That's just, 30,000 people on payroll. They're going to have to cut some if the stocks are just bleeding absolutely. And what was it? Let me see if I can pull up the one article that talked about, I think it's Mindscope, or I think it's, I got too many tabs. It was one where it talked about how the stocks in some of these absolutely tanked. Yeah, staffing stocks suffered in November. The staffing industry stock fell 3.9% after falling 26.6% in October. The index was down 37.5% through the end of November 2008. And that's just an average of all the stocks that were, staffing industry in across the markets in 2007, 2008. So obviously others individuals dropped 81%, 82%, 67%. And I wouldn't be surprised if we see those numbers again. This is kind of scares me because no one's talking about it. Everyone's talking about commercial real estate. It's almost like pick your own poison at this point, which one you want to short. And you can go into any industry and it's just going to be absolute, a blood waterfall. But I don't know. This one just kind of got to me. It's just a little bit scary to think that people are going to be entering a position where, but maybe when they come back, it's not going to be sunshine and rainbows. Maybe you're going to be working a job you hate, and it's going to be for less pay. And a lot of those positions that the position you went to school for that you're, qualified for aren't going to be around. They're going to, we didn't see a lot of those positions come back. So maybe there's just more companies right now. That's why we have more people looking for jobs and everything like that, and why the market is so extremely tight. But I think that a lot of these companies are going to go under, or, they're just going to have to go lean, and that's just going to destroy a lot of the job market right now and hurt a lot of people.
Okay. Yeah, it's one of those things where it sucks to talk about and to try to find ways to profit off of it, but that's what we're in the business of trying to do, is accumulate wealth right now. And it's a cutthroat game, but it's the game we're playing. So
yeah,
I would just say we're going to see a lot of volatility this week, the coming weeks, the coming months, the coming years. Have a plan, stick to that plan, and don't get caught up in fear and euphoria. Try to stay as even keeled as possible. That's what we got to do right now.
Yeah. And even at the worst, if you are in these industries, just prepare. I don't mean that in a bad way. I mean, just like prepare just in case if something like this happens. Obviously, I'm extremely bearish and I'm convicted to the end. I see what, an absolute economic collapse that's overdue, but I just don't want people to be caught out or surprised by what's coming, because those are usually the people that get hurt the most. And again, like we talked about financial literacy being so important, a lot of people don't have that, and it's just why the middle class, why people are just absolutely getting poor as others are getting way wealthier. It's unfortunate people don't know how to, invest or have the knowledge of all that stuff, but if you have time right now, just prepare and do everything you can to protect your wealth at all costs, and always be thinking macro, think ahead, 2-3 years from now, at least.
Yep. We're playing the long game here. All right, Kev, that is a good way to wrap it up for today. Big week ahead, a lot of data, a lot of Fed president speaking. And on the crypto side, we have the Shanghai upgrade to Ethereum on Wednesday. Interested to see how that plays out, with people being able to withdraw their staked ETH My understanding is those who've been running a validator are going to be fine, are going to be able to withdraw immediately. Those who've been using services like Rocket Pool or Lido are going to have to wait a bit. But either way, I think it's going to be, very interesting to see how the market responds to it and how these risk assets like crypto are treated in the coming, period of time where people may be losing their jobs. They might have to turn to it as a form of, might have to liquidate some for just to pay the bills, pay off the student loans that are going to be starting up again. That's another thing you and I have been beating the drums on for a long time that people aren't paying attention to, that they need to be paying attention to. So a lot of stuff that, can seem doom and gloom, but we're going to try to keep it as level-headed as possible. We're not going to bring you the Moon Boy bullshit. We are here to provide honest, objective, unbiased information. So that's going to do it for today, folks. Thank you so much for watching, for being here. We appreciate it. Hit that like button, subscribe to our channel, give us a share on social media, share the link to our YouTube channel. That is greatly appreciated. And we'll be back tomorrow. Not the same time. It's going to be kind of a weird week. I'm off to New York tomorrow, but we are still going to get content out every day. So stay tuned for that. Kevin, any final thoughts? And then we're out of here.
Just take care and be safe, everyone.
You heard it from the man himself. All right. Talk to you later, everybody. Have a good day.